In these volatile times, is your portfolio as structured as it should be? For years, hedge fund strategies have shown the ability to lower risk while generating healthy and stable returns. Some of the most successful strategies use options. Financial experts say active and skillful management of index options can protect portfolios in declining markets and allow ample participation in rising markets.
Options are contracts to buy or sell something at a set price at some time in the future. In the case of index options, that something is the value of a portfolio of stock or an index such as the S&P 500 or the Dow Jones Industrial Average. Those indexes move up and down, obviously, every day, and options are mathematically tied to the performance of that index. And by using options as a hedge, we can achieve negative correlation, which is the holy grail of diversification. It's when you invest in two different investments that have a positive expected return but are not correlated to one another. Options are priced based on a well-known formula that includes the current price of the asset, the strike price, interest rates, time to expiration, and the implied volatility, which is the expected movement of the price of the stock in the future.
Options can be analogized to insurance. As an investor who has a stock portfolio, you have two choices. You can buy puts, pay premium every single month, and protect your portfolio against loss. Or you can be like the insurance company. You can sell index call options, collect premium every single month, knowing that at some point in the future, you will have to pay out on a quote-unquote claim when the market drops. Because options are overpriced, you will make a profit over the long term by taking the latter strategy. We recommend that investors sell index options. There's several reasons for this. First, the investor has selected his stock portfolio with a particular reason because he believes the stocks will outperform the market. So we do not recommend selling options on those stocks because that will cut the profits of the stocks that the investor thinks will outperform. What we're looking to do is to reduce or eliminate the market risk of the portfolio. No matter how good your stock is, in 2008, your stock will go down.
Alan and Josh are the managing partners of the Gargoyle Group, one of the nation's most experienced private options firms and a foremost practitioner of using options to hedge equities. Headquartered in Englewood, New Jersey, and focused on the disciplined and skillful management of risk, the Gargoyle Group manages sophisticated value-adding option strategies to increase the probability of its clients' investment success.
The mission of the Gargoyle Group is to help investors. They could be investors of $1,000 in our mutual fund, anywhere up to billion-dollar pension funds that give us a portion of their equity portfolio to overwrite, to sell options using option strategies that we've developed over the last 25 years to help them improve their risk-adjusted return.
Our extensive research has found nothing that beats the results of a disciplined index call selling program that constantly monitors market risk and maintains the proper hedge at all times. By selling overpriced index call options in a conservative and disciplined fashion, an investor is able to make money in the options portfolio in all environments except when the stock portfolio is up significantly. In that case, the options portfolio will lose money, but it will lose less than the stock portfolio gains.
A leader in the risk-reducing use of index and equity options, Gargoyle's overlay strategy is equally relevant to active or passive portfolios and can be implemented without disrupting any existing investment relationships.
The overlay strategy that we employ at Gargoyle is really not that complicated. A lot of people are familiar with a buy right. Buy right is where you buy a stock and sell an option on that stock. It reduces the risk of owning the stock to some degree, but the problem with that is it also cuts the potential profit of selling that stock. What we do instead is we take a portfolio of stock. It could either be a portfolio that we select at Gargoyle, or it could be a portfolio that our client selects. We don't disrupt that portfolio. What we do is we find a highly correlated basket of indexes. We then sell options on those indexes, and that reduces the market risk of the portfolio without affecting the portfolio itself. What this does in the long run is increases the return of the portfolio while reducing the volatility and the risk of the portfolio over the long run.
The key to any option strategy is its implementation. By definition, a stock portfolio is 100% long stock. By the disciplined selling of index call options, we can reduce that exposure from 100% to whatever target an investor wants. The second key is that over the period of time, as the market fluctuates, the net long market exposure will also fluctuate. So it's very important to have a disciplined approach to adjusting the options portfolio to maintain a somewhat constant net long market exposure.
The Gargoyle Group continues to offer a product mix that allows investors to calibrate their exposure to the equity market. By offering products ranging from a moderate degree of market correlation for those who have a long-term favorable outlook for the equity market, all the way to the negatively correlated products for those who wish to reduce their market exposure while increasing their return over time.
The most rewarding feedback that we get is when investors come to us and tell us that if it weren't for us, they wouldn't have invested in the market to start with. We offer a way to invest in a hedged fashion, which allows them to reduce some of the risk, and their apprehension can fade away as they invest in a portfolio that's hedged, allowing them to have significant upside potential without all the risk of owning a stock portfolio. This is especially true in an environment such as we're in now, where yields are so low on safe investments that people try and stretch a little bit to get a little bit more return. And with us, they can do it in a hedged fashion that allows them to get a higher long-term return without adding to their risk.
Through the use of a dynamic index options overlay program, it is possible to simultaneously reduce risk and enhance the performance of an investor's existing equity portfolio.
There's a common misconception about options that they are risky. And in the wrong hands and in the wrong strategy, that perhaps is true. But the strategy that we are advocating is very conservative. In fact, the buy right strategy is the only strategy approved by all brokerage houses to be used in individual retirement accounts. The bottom line is that in the hands of the right advisor, any investor can have his stock portfolio's volatility reduced and returns enhanced over the long term through the disciplined and conservative use of options.
Learn more about the Gargoyle Group, increasing the probability of success. For more information, go to gargoylegroup.com or call 201-227-2200.